Good morning, marhaba. Welcome to another edition of PE Forum. Today, we welcome Fahad Al-Sharekh, General Partner of the Jedi Fund with Camco Invest and Vice Chairman of Camco Invest, Saudi Arabia. For those who don't know him, Fahad has been at the intersection of tech and finance in the Middle East for a long time. He founded in 2015 Techinvest, which helped basically Middle Eastern investors access key opportunities in the tech sector in the US and the West. Throughout his experience, he has advised on more than $900 million of transactions. Fahad, thank you so much for joining us today.
Thank you, Khalid, for having me. It's a pleasure.
So, Fahad, I want to start, when you started in 2015 and you go see an investor in the Middle East who's used to real estate and you talk about tech because you were one of the pioneers, what were the initial reactions?
Well, you're right. Alternatives in general is something that is not of big appetite in the region. People are more comfortable with more liquid asset classes, including securities that give dividends, public markets, and real estate. The only thing they look at as an alternative is real estate. They really shy away from private equity, and then growth private equity, which is venture capital, is to them very risky. I think the awareness started mid last decade, around 2012, 13, 14, really after the GFC. In a couple of years, the iPhone and the App Store took off, and everyone started realizing that their life really became in their palm, and they're not exposed to any of these apps they're using, including Uber or WhatsApp, Instagram, Snap, and more functional apps that do fintech or do other forms of travel, Airbnb, etc. So that really was the inflection point where people started considering doing some sort of alternative investments, in particular in growth tech startups.
And so today with the Jedi Fund, what is your investment thesis? What are your objectives?
Well, the Jedi Fund is a fund that I have founded with Camco Invest, which is a Kuwaiti asset manager, and they are regional because they are registered and regulated in several markets, including Saudi Arabia, the UAE, Kuwait, and we have offices in UK, Egypt, and DIFC. So we decided to launch this fund a few years ago. It's called the Jedi Fund. The Jedi stands for the Joint Emerging Managers and Direct Investments Program, where we decided that, so the thesis is we have to go find the emerging managers who have the most proximity and access to the most interesting founders. And the founders will give them the allocations in the companies early and materially. And we have this network of about 20 emerging managers that we've backed, or 20 emerging managing strategies. Some managers we've done 2 or 3 times. So I think maybe there's 15 different managers. Some of them we've invested in a couple of 1 or 2 of their funds. And after a while, we have a big net of startup companies that we've invested in indirectly. And then, with data mining and some data analysis, we are able to predict the breakout companies early in these emerging funds, and therefore we can deploy directly and co-invest with the emerging managers in the second or third round, which puts us early in the growth stage investing. So around the B round, we have direct access to the best companies that are coming out of these emerging managers. And I think that's how we built this funnel. And we're very happy with the direct deals that we've had access to over the past couple of years.
So this reflects as well a change in the region, because you've talked about it very often. We're a region that is focused on hydrocarbons, very reliant on it, and there's been a shift to diversify the economy. You're at the forefront. You've dealt with sovereign wealth funds throughout your career. How do you see sovereign wealth fund today diversifying and applying this strategy when it comes to growth and even tech?
Yeah, it's a good question, but the sovereign wealth funds, different ones have different objectives. Okay, and so some of them are like the Kuwait Investment Authority. They're really all about offsetting the dependency on hydrocarbon and investing for investment sake purely, and for return sake purely. So they have an objective of doubling AUM every 10 years, so that at some point they can be reliant on their investments as a source of capital, um, hand in hand with exporting hydrocarbon products. And if you get to a certain level, then the profits will be as equal to the revenues and the net profits you get from selling oil. And I think the KIA is focused on that sort of diversification. So we're going to leverage oil sales as much as possible, and then keep exporting oil and capital until the capital returns are equal, if not more, than the oil returns. And that's sort of the offset, and that's how they diversify. Others, like we see Saudi PIF and other Saudi sovereign wealth fund entities, according to what they say in FII and what they release, they're investing in developing their local economy and diversifying it through promoting tourism and FDI and manufacturing and other sort of businesses that can help, boost their economy. And others do it for diplomacy via private equity, basically, keep investing with influential groups, be it in the West or the East, and get to the objectives that way. And in general, institutional investors, in general, are long-term investors because their investment horizon is different than a retail product or a family office, and so their behaviors usually are different than those of retail. But sovereign wealth funds in general have the most unique way of investing because of the three examples I mentioned and the different objectives.
And so if we focus on the private capital domain within all the other asset classes, do you feel that there's a growing interest, whether it's for sovereign wealth funds or families in the Gulf region?
Yes, in Davos in 2016, there was a panel discussion by the sovereign wealth funds, and everybody was on the panel. Whether it's some of them from Canada, like Alberta, and some from Europe, Kuwait, Mubadala, the Norwegians. Anyway, so the point is, there's a collective, of discussion, and the conclusion was that the only way for sovereign wealth funds to be able to double their AUM every 10 years, as they want to do, is to have to make basically 7% net return every year, and that compounds in 10 years, to double what they start. So if you're like 100 billion, you should be 200 billion by then, and you want to make 7 billion every year in net. So they cannot do that with public equities and fixed income anymore. They really need more exposure to alternatives and the private capital markets in specific, and private equity and growth private equity. And so that was the most sanitized way of saying we need more exposure to venture. And we see how a lot of more money has been pumped into venture. Some of it smartly, some of it not so smartly. But there was a huge influx of money into tech, which promoted a lot of development as we see today, AI and all kinds of developments and leaps in R&D happened because of that great influx of capital, and also a lot of silly things like Bored ape monkeys and pictures and NFTs with, which are JPEGs of serial numbers that people exploit the vulnerable. But that happens in every industry anyway. And we saw crypto go through its cycles, and now it's really just about Bitcoin. So what was all that noise about then with everything else? So yeah, there's a lot of pros and cons of that huge influx of capital, but it did happen for the past 9 years. There's a lot of more capital being pumped into VC. It stopped in 2022. A lot of the institutional investors really backed out once there was a major correction and confusion. They backed off, and so now I think the capital is smarter again, and which means the money is going after capital efficient strategies and strategies where there's an actual a problem being solved, not developing a solution or looking for the problem it solves.
Before I move on to more the family, I just want to ask another question on the sovereign wealth funds. You mentioned the different strategies, and there's also a general will of GCC governments to anchor whether it's financial sector or some of these portfolio companies in the region. Do you think that you can easily do both, meaning find good opportunities in the West or in the US and at the same time have them anchor themselves in the region, or it's two different objectives?
What do you mean anchor themselves in the region?
So what I mean is that the more and more there's a wish of GCC governments to bring in, whether it's private equity or venture capital managers, to anchor themselves in the Gulf or some of their portfolio companies, but at the same time they want to invest in good companies and good managers. Does these two goals, I say, converge, or do you see them as two different analyses?
Well, I mean, Dubai, Abu Dhabi, and Saudi recently have been, promoting, their economies and their countries as ideal locations to domicile, an international office that covers the region. And Saudi's been very clear. If you want to come and work and get government contracts and get a lot of asset allocators from Saudi to look at you, you have to be registered in Saudi or have some sort of place in Saudi, which I think is very smart, because then it gives them, forces these managers to have skin in the game and have them be there and be accountable and not just fly in, fly out whenever oil is up and there's a surplus. They all come in and flock in, FII or Milken or Salt, I think, where we met, and so different things, and fly and disappear. That's not what they want. They want them to be here, hiring locals that are reliable, accountable, and available and accessible. And I think that's very smart. The other part of your question is, I think whether they will invest in the region and whether the FDI angle is something they look for. But in reality, the GCC countries, most of them are very small. Even Saudi Arabia, it's 30 million. It's as big as this. One of the, there's like 5 U.S. states, I think, that have as many people there as more. And as an economy, all the GCC countries together, there's a high disposable income. There's low tax costs, and it's attractive for many businesses, especially retail and consumers and Veblen goods and things like that. But the economies of scale are in the West. The economies of scale are in China and India. And the GCC, if and when they get more unified, let's say, tax agreements or tariffs agreements and customs, etc., then it could be one market. Then you talk about maybe like 40, 50 million people market with disposable income. Then it might be interesting, especially for tech companies to scale there. You have, a potential total addressable market of 50 million people with a variety of demographic and diverse, different types of clients. Then it could be something interesting. But I don't think they're exclusive. I don't think you should open an office here to manage the money you're getting. is one thing, and then investing in the region is another thing. And they don't even need to be in the region to invest in the region. You can invest in any market if it's good. So I see more and more companies opening up shop here, which is a healthy sign that this market is maturing and developing in the right and progressing in the right way.
I like what you said about, they want to see a bit of commitment from, whether it's company or managers that get money in the region. You do the opposite. So you source managers in the US. How important is it to build these relationship, and how do you when you mentioned the funnel, how do you go about it to choose them and to develop this relationship?
Yeah, look, managers before, they used to be in their location, whether it's, UK or Switzerland or Silicon Valley or, San Francisco or New York. And, they would call Gulf funds that come and invest, tourist capital, meaning like we come in when the market is good and invest, and then we disappear just like tourists. So they were alluding to something being, non-continual, or in, not like, let's say, institutional approach to investments where it's like, forced programs that are, decades long of investments, and investment horizons are continuously checked as a strategy. So 5 years, 10 years, 15 years, etc. That was what they used to, accuse people of here. And then, the sovereign wealth funds went and opened shops there. Mubadala has an office in San Francisco. QIA and PIF have offices in New York. Kuwait through Wafra has a big office in New York. And so they are there, and they do invest regularly. Now, the same thing is happening now with these Western managers. They just show up and raise money and disappear. So they're also pulling the tourist fundraiser thing, and they think it's just easy, come in and pitch and leave, like, they're the only show in town. But in reality, there's thousands of qualified asset managers out there, and they need to be differentiated on number one performance metrics, but also on accessibility, availability, and dedication to their GCC clients. And so the ones that picked up and pick up the behavior and of the community and how people like to behave, and just because you're from a certain part of America or a certain part of Europe, and your community behaves in a certain way, doesn't mean that's the standard, or that's the right way, or those are the values that matter. Other parts of the world have other values that they cherish and like and respect. Ethics, integrity, and displaying all sorts of positive characteristics is very important. One of them is being available and taking time to know your clients and educate them and be close to them, and not be presumptuous and think you can just fly in and out and make money because you're great. Because there's a lot of great people out there, and the better ones are the ones that take time to develop meaningful, real relationships and think of long-term terms, not quick, here, come in and get the money and leave. So that's what I try to educate the managers I work with on. That you have to come to the region, do several visits. The best time to fundraise is when you're not fundraising. You come and talk and be, show people how you're different. Give people time to understand the way you think and how you look at the world, which demonstrates your abilities of judgment. And of course, there's the track record and all sorts of analyzable data and performance. And, numbers then speak. People lie, people can be funny, but numbers are clear. And so it's a numbers game. And as I said, some sovereign wealth funds are purely interested in the bottom line. And I think those are the ones that make the most amount of money. The Norwegians came out today, is the highest returning, sovereign wealth fund in the world. And I think KIA does well because it's focused on the numbers. And so then there's no point of view or opinion or whatever. It's numbers. Who is the greatest of them all, and who is the best performer. And that's how you
And is
should.
it difficult to get into the greatest manager? Is it difficult to get allocation within these managers, you think?
I mean, the greatest is an opinion in terms of like what is the definition of great? Is it the size of AUM? Is it the returns? Is it the continuity of distributions, the DPI? So different people have an opinion. I think it's number one. Um, the most important metric is for the more established ones, the big guys, what is their DPI? What is their distributions per investment over the decade they worked at? So how much they give you. And so a lot of these big mega funds, big names, they take your money, lock it up for 12 years plus one, they 14 years wait, and then they distribute, and they barely give you 2.5x net on net, cash on cash net. Whereby some of the more emerging managers, they're more eager, they're hungry, they're thirsty, they want to prove it, they have better access, and they're not as rich, so they work harder. And they might not have 12, 20-year track record, which alleviates some concerns of some CFA sitting there trying to, build a case why this, $5 billion fund makes sense. When the DPI and the returns have been low compared to emerging managers, which can give you sometimes up to 20x, right? And so it's an opinion here. What do you want? And then once you know what you want, then you go down to the numbers. Which emerging manager has displayed the best access to the companies, startups that had the best markups from the best investors like Andreessen and Sequoia. And those guys, although there is no DPI because it's been less than 10 years, but at least it's attracted the smartest capital, which has had the best DPI. So there's ways to kind of correlate all of it and figure out which ones are better than the others.
So your focus is mostly outwards. There's also a new breed of local VC and private capital managers in the Middle East. How do you see this environment developing?
Well, I don't focus outside. I focus specifically in the U.S. Bay Area, which is San Francisco and and the towns around it. And so, if you look at the top 10 tech producing towns, you'd see that Menlo and Palo Alto and Cupertino and San Francisco, San Jose, all those are in the top 10. And then you have Boston, New York, China, maybe the UK in that list. So, and then other places in America like Atlanta, Chicago, Seattle, LA are also up there. But most of them is in the US Bay Area. So the US Bay Area is way ahead of everybody else. And so why focus for me? Why would I want to focus on anything else? And so the reason why I like it is besides the fact that it's the most mature ecosystem. What does ecosystem mean? It means it has the best universities in the world that are focused on engineering and computer science and data science and AI, like Stanford, Berkeley, Caltech, and other great universities that are based there. You have all the VCs are there. They've been there for 30 years sometimes, like NEA and Kleiner Perkins, and Benchmark and others like that. And then the new ones that are, Sequoia, not new, but you know what I mean, other ones like Andreessen Horowitz and Y Combinator, AngelList, and then the new ones that are coming up, the solo capitalists, the solo GPs, like PowerSet, like people that left AngelList and left PayPal and left Y Combinator and set up their own smaller VC funds or micro VC funds, which is what I like, the 5 million to 20 million size, because capital is the enemy of returns and really don't want a big fund that does seed or early stage. They're going to get sloppy and complacent. They get carried away. So I like that sort of discipline. And most importantly, the talent, meaning those universities and these and of course, sorry, the big companies, whether it's Google, Facebook, Cisco, X, they're all based in the US Bay Area. And having all those engineers and computer scientists and all the students and all the professors, all and the VC and all the money in the same area, that is what an ecosystem is. So Boston is struggling to match the ecosystem. In New York, in UK. So I'm not really sure how that ecosystem is going to be replicated in the Middle East, because you don't have one company, one university that is top 1,000 in computer science. You don't have one university that's top 1,000 in computer engineering. So where are you going to get the talent from? And you don't have tech companies that have been here for 5 decades. So where are you going to have those mentors and engineers that know what they want? And they don't have VCs, and if you have a VC, it's like one fund of funds that backs funds, but you don't have 100 seed funds and 100, early stage funds and 100 late stage funds and 100 pre-IPO funds, and then private equity funds in the billions that will back these companies in case there's no IPO. That is what's called an ecosystem. So there's no talent, no education, no money, and no public markets that allow for these companies to go public. So people get carried away with buzzwords and throw ecosystem in every, city in the region, but there is no ecosystem. And I don't care how people feel about this, but if there is, show me 10,000 graduates with computer science degrees that I can choose 10 of them, they're going to build the next DeepSeek competitor. Okay, and so it's not an opinion. Again, it's output. Where is the tech? You're going to tell me Kareem, an Uber knockoff? Okay, great. But where is the tech there, right? I want AI, we want data science. We want to see something that is beyond, Having said that, I think also the region could be great for AI companies to do training. So and this is what's happening anyway, they're investing big time in data centers that will use the fact of energy arbitrage and the weather here. It's dry heat, and it's convenient to build mega data centers. And the desert definitely has a lot of space. You can build 2 million square meters of one mega data center and have several of them, whether in Saudi, Kuwait, UAE, whatever, and that can serve a purpose. And maybe that will be a quickest hack into building something that the companies might want, and maybe they will come here and launch because of that access, so they can train on the compute. But you need a lot of work, and number one, education. At the end of the day, it's a talent game. The talent everywhere in the world. If you're the best Polish coder, if you're the best Czech coder, if you're the best Filipino coder, your dream is to move to California, and that's what's happening. And that's why a lot of the immigrants move there, and companies, Elon Musk is an immigrant, Vinod Khosla is an immigrant, Sergey Brin is an immigrant, but you don't see them launching their companies back home, do they? They launch it in Silicon Valley. So in reality, that's where their ecosystem is.
Anyway, in ecosystem, if you take nature, you have the strong that eats the weak, and sometimes ecosystems disappear as well. Nature is an ecosystem. We kind of forget that, but so if you look at what your objectives are, do you think that investors are more demanding towards external managers versus the local managers? Does that translate into that? They're more tolerant and expect less results because they consider that it's more of a long-term and creation of a sort of a beginning of an infrastructure for tech?
Local versus, look, we are, a local investor, a regional investor. Camco is registered in Kuwait and Saudi and UAE, but it's a Kuwaiti company. It's 25-year-olds, 26-year-old publicly traded company. Got about 17 or 16 billion AUM, depending on the stock market, how it's doing today, and if it's up and down, but that's sort of the ballpark. And we have decided to offer, our access to our clients, institutional and retail, from the region, and as an asset manager, and then take that money and give it to emerging managers in the U.S. as an asset allocator. right? And so that was really the conduit and the role we played, because we have access to both and we know what to do. So some people think of us as a local manager. Some people think of us as an international manager because we're putting the money in Silicon Valley. Now, if you're asking whether people like to invest with local managers that invest in the region, or would they like to invest in international managers that invest internationally, that really depends on their appetite and their research and how they think they're gonna increase their AUM. At the end of the day, it's really about making money, right, and leveraging opportunities.
So how do you compare, I'd say, the Silicon Valley managers to managers in the region, and you think that investors in the region are more tolerant to poor results coming from the region and more demanding from foreign managers or US-based managers?
Look, certain people just have better experience, okay, because they've done things longer. And people learn from their mistakes. And so if you go to a US manager, they've probably been in the game for 20, 30 years, and they've learned from their mistakes. And therefore, the good ones don't repeat the same mistakes. And they're called wise. In the region here, a lot of people, like, if you look at the 200 VC funds that have been formed, 90% of them never done VC before, or started the company, or were in private equity. They're just enthusiastic and excited about the space, and everyone's drinking everyone's Kool-Aid, and therefore everyone's surprised their money disappeared. And then they will say, oh, the regional managers are horrible, or VC is horrible, but it's not. It's that specific manager that has zero experience doing things that he doesn't know. So like right now, you're a great guy, Khalid, you're smart. I wouldn't trust you to run a cricket team because you have no experience in it, not because you're a bad person or cricket is bad. I shouldn't be teaching anybody synchronized swimming or building a rocket, because I wouldn't know anything about it. But if there's all of a sudden, if everyone in this neighborhood decides that synchronized swimming is the thing, and I go bring a team and I want to go in the Olympic, you'll think I'm silly. And that's how I feel about a lot of people here. And it's not just the region, okay? Let's be honest here. When big funds like SoftBank Vision Fund comes in and it's 100 billion, and hires a lot of people with impressive financial backgrounds, but none of them really is from a VC background or a startup guy or lives in San Francisco. No offense to Deutsche Bank and Citibank and whatever they came from,
but they're good in financial engineering, so that's something.
Yeah, they're good at losing a lot of money too. And so they invested a lot of money in WeWork and other things that didn't make sense. And now they're barely returning capital again. I think they're at 80% or 85% returning their capital. So DPI wise, it's negative and lost opportunity. So like if you put that 100 billion, if you put 1 billion of it in OpenAI instead of that, all the other things they put money in, it's all the same timing. So there was OpenAI and WeWork. They put 60 billion in WeWork. They sold NVIDIA to invest in WeWork. You see what I mean? So not the smartest investors in history. Again, it's not my opinion. It's numbers that matter, right? I'm not saying someone is in particular. I'm saying that strategy, the numbers that came out of it are horrible. And so, yes, you have to choose managers wisely. Doesn't matter where they are. Do they have the experience? Do they have the track record? Have they distributed money before? If not, are the investors in their funds people that are known to distribute money materially? And those are the indications that you should focus on and not just follow a trend that's stupid, like the NFT trend or the Miami, or, it happens everywhere, right? There was a crypto thing in Dubai for a while. There was, everyone and their mother doing some sort of coffee delivery app, and people were putting money on it. I don't understand the unit economics or the barriers of entry, or what problems are we solving here? I like to focus on software and software that can be sold on a monthly basis, like SaaS, that is, that's needed to fix a problem in an enterprise that requires it to become more efficient. And that is what technology really should be about. And that's what we're seeing. And that's why there's a lot of excitement about, AI and SaaS, because it's going to make people more efficient.
So typically, the emerging managers you invest in, are they breaking out from a previous VC and setting up their own firm, or are they successful entrepreneurs that exited several times? Do you have a sort of I'd say a prototype of what you're looking for?
Good question again. Yes, Khalid, all your questions are good, but I mean, this is the challenging one. So I like to say, yes, the way I select emerging managers is I prefer them to come out of VCs, because then you can see their track record in the VC, what they've chosen, and it's called, I think, an anti-portfolio, which means how much they've done well and how much they passed on that did well and how much they invested in that didn't do well, right? And so then you can build an idea of the person. And number two, their expertise and access. So, for example, great VC one, okay, let's say tier one, like Sequoia and Andreessen, that level benchmark. Their young data science and AI partner left. And that person knows everybody in data and AI. And if he does a small $20 million fund, a lot of the young founders are going to come to him because he knows a lot. And usually when they leave these big firms, the big firms invest in them or the partners invest in them. So you have also other signals that these guys are good. And usually you need to know them personally, because these guys are obscure and they would have their fund raised before they leave. And so they don't risk leaving until they have secured the capital of fund one. And based on the performance in fund one, then they do fund two, and then they don't need any more LPs for fund three. It's locked. And that's why you need to go in early. Otherwise, if someone is soliciting funds and sending you emails about late stage companies and it's in your inbox here, this is the signal for you not to do it, because it's desperate. Wherever they're from and they can't do it, they're VCs that back them. They also don't want to put more money in it. There's a lot of indications of a company or fund manager that to let you know they're not as great as they seem. And if you go to Silicon Valley, if you go to San Francisco, and you meet everybody there, everybody went to a great school. Everybody worked in a great company. Everybody had some sort of operational experience that's impressive, or worked in a VC X or VC Y, and everyone has some guy that sounds good that's invested with them. It sounds like a casino when you walk in and see all those, it says jackpot, just one more quarter, and they have the numbers out, and everyone is sitting there saying, "Oh yeah, I can't wait to do these slot machines, and I'm going to win, and I'm going to do this." That's what it feels like. But the odds are against you. So people need to calm down and fundamentally figure out the basics of the business. I need people that are great, just like you want to do a football team, right? You want people, before they move to your team from another team, you have their highlights, their reels, their scores, their everything. And then you do a health check on them, and then you get them in your team, and you hope they can score, right? And so it's not easy, but you need a lot of patience and really
consistency as well. This is something that characterizes you. I mean, you many people, as you mentioned, jump from trend to trend. You've been always, saying the same focus, staying with the same focus, and I think this is what will also bring results. If we take, I don't want to go into these single opportunities that are on layer and layer of SPVs that some Middle Eastern investors receive that you just mentioned briefly, but with your managers today and what you're hearing, are there particular sectors or domains or focus of interest that you think are exciting for the future?
Again, I think software is the most exciting thing. When they say software is eating up the world, and you look at the automation level now, even with all the AI and all the post-COVID, transformation, digital transformation that happened, we're still like 70% running manual. The retail market, e-commerce is only like 20% of the market. Imagine with all the efficiency that it provides, people still go to stores and people still like, take their things and bring them back. And so we're not even there, as much as you think we're connected and the phones have connected us all and 5G and all that. It's really, I think, in the beginning of, AI definitely, of generative AI, let's say, highlighted what's possible, even with all its hallucinations, and we still see the potential that maybe the enterprise will move into an AI world soon with AI agents. But that needs a lot of work. That needs a lot of software that analyzes software. It's called the picks and shovels of the AI industry is software. So we want to invest in those companies. And, like the company that made more money on, Uber or Lyft or any of the other competitors was AWS, because everyone's hosting there and they're charging every ride. They make money on everyone's ride. And AWS uses a lot of software, right? Amazon's not a software writer, right? They buy and hire and do things, and they focus on their core. And so there's a lot of companies are making a lot of money, selling software as a service to service these mega industries. And with AI coming in, it's going to force a lot of industries to move into a digital based, economy. And so the consistency in the thesis, Khalid, is what makes us who we are today. And that's based, again, on numbers. I don't care what people think of me. I care about the numbers we post. Our TVPI, our MOIC, our DPI puts us in the top quintile, not even quartile. We're in the top 20, if not in some strategies, top 10, top decile, because of focus, okay? And because of not being a fair weather fan and jumping from one fad to another trend, from crypto to bikes to I don't know what, e-bikes. How are you going to do e-bikes in this part of the world? Does anyone stop and think for a minute, right? And there's no pedestrian lanes for people to walk, and there's and even in Europe, how is Bird doing, the bike company? I don't care if Sequoia backed it. Sequoia backed FTX. So what? It doesn't say anything about those companies. Sequoia remains to be the best in the best, and they will have 5 to 7% zeros. So what? But you need to have a brain that can help you determine your own judgment. What am I doing? And not just be blindly following every trend. And no, we're very proud of the fact that we like software.
So I mean, you come from a very well-known family that initiated and pioneered as well software within the Gulf region. As time goes by, you think it would stay your favorite investment thesis, or would you, on a personal level or generally speaking, what would be the other investment that you would look at, if not software? As an asset class, I mean.
I think in 5 to 10 years, investments are going to be done by AI. And I think we're the last of the Mohicans. And so once we find the right companies to invest in, software, AI is software. What's AI? AI is really understanding data, and data is built on using software tools. So once AI agents figure out the most optimum ways, and you remove human emotion, umbilical cords to stupid ideas, objectivity, racism and xenophobia, all kinds of human errors. AI will be a much better, judgment taker or maker. And so I think we will focus on software for the next 5 to 10 years, and then software will just figure out the rest.
Thank you. Fahad, it's always a pleasure discussing with you. You're a straight talker, so it's always enjoyable for me to have a conversation with you. Thank you so much.
Thank you. But one more thing, Khalid. Remember what I told you about that thing? Who was right, who was wrong?
Sorry, I didn't hear you.
Remember when you talked to me 5 years ago about an investment, and I said you should be careful. It's quite dilutive. It's capital
absolutely
intensive. And
hardware is, yeah. I heard, yeah, we learn with experience. So I learned about it, and you were absolutely right. And I told you so in our last conversation.
yeah,
Is that
it's the
I
software.
didn't get the allocation, but it was a good thing for me because it turned out to be very extremely dilutive. So I agree with you. Now I'm on software like you, so that's good.
All
Thank you
right,
so
great.
much, man.
Thank you, Father. Thank you
Thank
so
you.
much.
Have a
Appreciate
great
it.
day. Thank
Thanks.
you.
Bye
Thank you.
bye.
Thank you.